Well, good afternoon, everyone, and welcome to a policy forum with the Competitive Enterprise Institute. I'm Kent Lassman, and today we have a surplus of expertise on consumer financial regulation. Two quick reminders for our audience. The program is being recorded and we'll make it available on our website and at YouTube. All of the programs, including our book forums, are archived at cei.org. I encourage you to share these presentations and to give us feedback. In fact, there'll be an opportunity at the end of the hour for a very brief survey. It takes less than 90 seconds. And second, I want to share your questions with our speakers. So I encourage you to use the Q&A function that you find at the bottom of the screen or email during the program at events@cei.org. Today, we're going to explore credit and banking markets and what can be done to make them work better, and importantly, work for more Americans. I'm particularly interested to learn about regulatory relief that can make new entry into the market more common and the development of innovative financial products, services, and ultimately institutions. To really dig into these issues, we'll explore what promises to be a landmark publication. It's one of the few documents written by committee that I've seen lately that combines clear prose, easily intelligible economic analysis, and very specific recommendations for policymakers, either on Capitol Hill or in the regulatory agencies. In fact, there are scores of proposals to add a layer of resilience to our consumer financial markets and to open the door for innovation. Todd Zywicki served as the chairman of the task force created by the CFPB. In addition to serving as the chair and on the CEI board of directors, Todd is also a professor of law at the Antonin Scalia School of Law at George Mason University. To get a perspective from people who must consider and implement these proposals, Kyle Hauptman is with us. Kyle is the vice chairman of the National Credit Union Administration with a mandate to ensure deposits, protect the owners of credit unions, and charter new credit unions. He has a front row seat for critical market and finance. And to round things out today, I'm joined by CEI Senior Fellow John Berlau. John has written extensively about capital markets and access to financial services, as well as to entrepreneurship and innovation in finance. His latest book, George Washington Entrepreneur, you can find an archived conversation about that book on our website. And with this panel of experts, I know we're set to learn a lot in the next hour. So after brief remarks from each, we'll get into the meat of things with a discussion for the balance of the hour. Todd, I want to say welcome to the forum and thank you for being with us. I'd ask you to frame our conversation with an explanation of this task force. Your recent publication came in 2 volumes, and how it all came together, and perhaps even tell us a little bit about how the 5 principles that guided your work were selected.
Well, thanks, Kent, and it's a real pleasure to be with you here today. And thank you for the opportunity to serve on the CEI board, which is one of my great privileges. And it's great to be with you. CEI is doing great work, as they always are, and it's a pleasure to be with you and John, who I've learned so much from over the years. And particularly Kyle Hauptman. Congratulations, Kyle. It's great to see you over at the NCUA. And I know we've got a few recommendations that will warm your heart as a believer in competition and regulatory innovation. So I'll just say a few words about the background to our report. And then, as you said, I will talk about some of the overarching themes to frame our discussion. So this came about in January 2020. And I want to thank former CFPB Director Kathy Kraninger for launching this initiative, which I think is very important. And it's important to understand the historical context, which is not just some sort of Trump type thing. You can understand this as sort of a regular updating and part of an ongoing pattern in American history. You can go back a century to the 1920s. What we saw during the 1920s was Americans left the farms and moved into the cities, and immigrants flooded into the American cities. we had need for access to consumer finance. You didn't need that so much on the farms and the like. But basically what happened was people moved in, they needed access to small dollar credit, they needed access to liquid funds and the like. And what happened was they ran smack up against the Victorian lending laws that had been in place for decades. Strict interest rate ceilings, limits on what financial institutions could do and the like. And the reality was that basically what happened was that they turned to illegal loan sharks in order to make ends meet because it was impossible to lend to wage earners at a competitive rate of interest. And so foresighted reformers at the time, particularly the Russell Sage Foundation, working with consumer advocates, said, you know, it's better to have fair and transparent markets than it is to basically have people being in hock to loan sharks, leg breakers, and the like. And it was a real problem. Alan Greenspan once referred to it as virtual serfdom. As many as 30% of New York City employees owed money to illegal loan sharks in the 20s. And then basically what happened was there was a move towards reform and modernization at the time, which unfortunately after the Great Depression got rolled back, which is a theory actually emerged during the Great Depression that one of the things that caused the Great Depression was too much access to consumer credit. Stop me if you've heard this story before. And so what happened then was during the 50s and into the 60s, again, they brought back a lot of these old regulations, often at the behest of entrenched interest groups, such as banks and the like, to protect them from competition, often just misplaced paternalism that basically said consumers shouldn't have access to this. And so what ended up happening? Well, by the 1970s, loan sharking was back. For example, a 1968 Senate report reported that loan sharking was the second largest revenue source of the mafia. In 1970, an estimate by an FBI expert on organized crime estimated that the entire illegal loan sharking racket in the United States was about $10 billion, which to give you a sense is about $69 billion in today's money, which to give you a sense of that is about twice the size of the entire payday loan market in America, both in person and online combined. You could take away the supply of credit. You can't take away the demand. You can take away supply of access to financial services, but not the demand. The second thing that happened was during the 50s and 60s and into the 70s, we saw this movement towards a more national consumer financial market. This was because of particularly department stores, which merged and became national chains with centralized ways of extending credit to consumers. Most credit for the middle class in the 60s and 70s was retail credit through department stores, but also there were a variety of installment loans, personal finance companies, and the like. But just to give an example of technological change was the declining cost of long distance telephone service made it possible for debt collectors to actually start collecting debts across state lines, which made the old state-based mechanism of regulating debt collectors obsolete. And so we needed modernization. That was in the 70s. Now we don't just have a national market, we have a nowhere market. We have the internet. People have changed the way that they consume financial products, the way they use them, the way they shop for them. And to Director Kraninger's credit, that's where we came in. She asked us to study. She basically had three things. She said we give a consensus report where we evaluated the current consumer financial regulatory system. We came up with consensus recommendations on how to update it and reform it, and we do it within 1 year, perhaps the most daunting part of it, which I'm proud to say. And as Ken said, the final report is 900 pages long in 2 volumes. And I'm going to just give you a quick overview of the themes that are in the report, which we have 5. I'm going to narrow it down to 3. The first is a focus on inclusion. This is a big issue today, obviously, and a lot of our debates are over inclusion. And you can think of promoting inclusion in 2 ways. First would be to repeal regulations that interfere with inclusion, such as the Durbin Amendment and the Credit Card Act. But second, regulatory reforms that promote inclusion, such as fintech, making it easier for fintech, promoting industrial loan companies, such as allowing Walmart to get a banking charter. And Walmart has, reformed every market that it's touched for consumer financial products. And one that I know Kyle will particularly like is allowing the NCUA to issue more charters to make it easier to serve low-income communities. So reforming regulations that interfere with inclusion, reforming in a way to promote inclusion. Second, we focus on modernizing the consumer financial framework. And in particular, consumers simply shop for consumer financial products differently. They want information on their phones. They want information online. And coming up with an updated disclosure system, an updated system for policing consumer financial protection that focuses on consumer harm rather than all the different scattershot goals that we have now is important. The third thing we focus on is modernization. This past year, one of the things that's fascinating about the report was that we wrote it during the time of the pandemic. We certainly didn't expect that. But one of the things we saw as a result of the pandemic were trends that we thought would take 10 or 15 years, took 6 or 9 months. The migration to online banking, the migration to fintech, all these different sorts of things, the migration to online, not in-person real estate closings, came up against a lot of old overgrown regulatory weeds, including a lot of them that were state initiated, that were just protected interest groups and nobody else. I mean, why do we still have notaries? Why do we still have to have in-person real estate closings with wet signatures during a pandemic? And so we need to have a system that can deal with crises better, a system that can be updated with how people shop and use consumer financial credit products today. And so we have a variety of reforms aimed at both promoting that as well as modernizing the CFPB. And finally, some particular innovations and particular things that need to be updated. Take the Equal Credit Opportunity Act, for example, which is, has a high degree of consensus behind it. But it was written in the 70s. The world has changed since the 70s. One of the things we suggest is maybe it's time for Congress to look at and consider including disability under the Equal Credit Opportunity Act, which is a general thing that a lot of people agree with today. But also think about one example in the Equal Credit Opportunity Act, which is in order to protect women in the 70s, they said you're not allowed to ask whether you have childbearing plans, right? Get the idea. But a whole market has arisen now to finance assisted fertility treatments, like in vitro fertilization. Do we really think that women are not going to get a credit card if they're going to have kids? But what we do know is that we have a regulatory system now that's based in the 70s before we had things like in vitro fertilization. Maybe it's time to go back and look at these sorts of things and update it and come up with a better system for writing regulations and laws. What we propose is a rules-based approach to financial regulation that can be updated better and more readily than the very prescriptive system that we have today. Thanks.
Thank you for that. There's a lot there for us to chew on through the hour. Kyle Hauptman, I want to get you into the discussion. As a board member at the NCUA, you work closely with 2 other regulators to expand access to credit and to get more people involved in wealth building. And I'd like you to share with us your thoughts on our current environment and specifically some of the recommendations that have come from this task force and that would put people on a path toward genuine consumer sovereignty. So Kyle, the floor is yours. I look forward to what you had to share.
Sure. Thank you for having me. I got a few minutes of introductory remarks here. Obviously, I speak for myself only and not for NCUA. I want to say great job by Todd and the other report authors. I really hope that under the current administration, that report does not sit on a shelf and it's used, because I think it is true consumer protection, what it's looking at. I'm aware that not everything in the report the CFPB can do on its own. But I'll say this, I have 3 priorities at NCUA that I've been public about, 2 of which are pretty germane to that report. One is accountability by public servants. We've seen with police body cameras, the vast majority of cops who are good cops, they like them. It provides accountability, it protects them from someone saying something about them, gives them information. And as public servants, we should be accountable. So we're trying to have an Uber style, some sort of feedback mechanism after you have your exam, not always about the exam, but about NCUA. You can't even order an Uber or a Lyft until you rate the last ride, and it's very clear from management of those companies what's a priority. Every single ride, the rider and passengers. Was the car clean? It's the first thing, right? So cleanliness of the car is pounded into everybody's head every time, passenger, driver, everybody. Something like that. And I'm proud that when I was on Capitol Hill, one thing that I helped get accomplished was CFPB finally put in an anonymous yearly feedback survey. I think we agree there's a value to anonymous surveys and to actual on the record, recording exams, that kind of thing. So we sent to the CFPB what the FDIC did, an anonymous one sent to everybody. They have a decent response rate, goes to the ombudsman. Prior to that, there had only been like a complaint line. People could call the ombudsman. It was the only feedback mechanism there was. And as you know, people are loath to complain about their regulators, right? Especially if they're going to see that regulator behind closed doors sometime soon. So lest I may digress. So priority number one was feedback. The other priority is de novo credit unions, new ones. We cannot talk about inclusion and access unless we're making it as easy as possible for viable credit unions to be started. There was an effort at NCUA, which I fully commend, before I got there last December, to look at that process and review it. And we're trying to see how we can make this easier, especially for underserved markets. My home state of Maine, one opened last year, very rural area, agriculture focused. It took them over 8 years door to door. And not everybody is going to have the patience of Job to do that. And keep in mind, when you start a credit union, of 11 million in assets or something, you do all these years of effort, and all you get at the end of it is a small nonprofit. Okay, this isn't like Silicon Valley where you put in all this effort and you hope to go public, or even starting a bank where you have investors may get a return from it. So we're trying to streamline that. We think it's very important. We lose about 200 credit unions a year, mostly through mergers. It's not always bad news. About 200 a year, and we open up 1 or 2. If we can get that up to 5, I would call that a win for now. As recently as the 90s, we had 20 a month being opened. So if we are not making it easy for groups in geographic areas, underserved markets, wherever, to open one, then we can't really talk about diversity and inclusion. So we want to make somebody responsible for how many we're opening that are viable, where they are in the process, how long it takes, have metrics around that. I'm pleased to see right now in the hopper, we don't know if they're going to get a charter or not, but we've got one called Returning Citizens. It is formerly incarcerated people trying to start their own credit union. I think it's fabulous. Now they have to prove that it can be viable, but if we're not making groups like that eligible, then we can't really talk about financial inclusion. We have another one, a couple working through the HBCUs, historically Black colleges and universities. Another example of people who want to have their own financial service provider. If somebody wants to leave their current provider, the best thing is to have a better deal someplace else. That's freedom, that's free enterprise. Maybe even better is starting your own. So we want to make that easier. Back to CFPB, I think the original sin, as it were, is just the way it was set up. The way it was set up originally, it can't not be problematic. It doesn't matter who's staffing it. If you have guaranteed money coming in, which the CFPB does, total power over pretty much anything where money changes hands in America, and there's no accountability, anyone on their worst day is going to behave poorly. And look at the metrics for succeeding there, right? You don't have a P&L. You want settlements, headlines, fines, returning money to consumers. The result is fairly obvious. I don't think it's healthy in life for anyone to have a life where no one says no to you. We would all behave poorly. So, the CFPB has sort of structural issues. Now, the director now apparently can be fired by the president. I suppose that's a step in the right direction. But I am proud of getting CFPB to do that anonymous feedback mechanism. That's at least something. It was met with a lot of pushback internally, as I understand it, but that's human nature. If you never had any accountability, a little feels like a lot. Director Kraninger, I thought she did a good job. My boss voted for her. It was 50 of 49. I like reminding her that my boss was the deciding vote, which isn't untrue. And I'll say this, during my confirmation, one thing I said is the best consumer protection is having a better choice. If somebody's struggling to pay a loan at 20%, it might be nice maybe, that somebody in government feels your pain and they're bashing the lender and doing lots of regulation and having lots of meetings with them. But what do they really need? A loan at 10%. So I commend the CFPB's report about new options, letting the market work. It's powerful, it's effective. It's ironic that in response to bad products, high prices, poor service, okay? In response to that, the Dodd-Frank set up an unaccountable monopoly provider of those services. And look at the mandate. I think that's an issue. UDAP. I was just asked about this because the larger credit unions now are have to deal with the CFPB. If you're 10 billion or over, it's not that many, but they now have NCUA and CFPB regulation. And it says, well, what is unfair, deceptive, and abusive? Well, I don't know exactly how I would define it. And I think the vagueness is part of the problem. If you just look at interest rates, I think usury laws are normally done at the state level. The highest I've ever been charged in my life in any sort of percentage for being late or for not paying what I owe is by my own government, DC. I have a business license here for a rental property. It's $190. If I am 1 day late, it's $440. If I'm 30 days late, it's $690. That's from my own government. That same government has a usury law to prevent people from lending at higher rates, far lower rates than my own government is charging me. There's a national interest rate cap bill in Congress, as you probably know, sponsored by a good senator from Oregon. And it's 36%, I believe, nationwide. Let me say this, in Oregon, just to give one example, there's an entity, if you owe them money, it doubles every 90 days. That entity is the city of Portland, Oregon. You get a traffic ticket or something, you owe them $100, it's 290 days, it's 406 months, and that $100 you owe them becomes $1,600 in a year. That is in the state of Oregon. There are examples like this across the board. So, and it's ironic that one of the needs for short-term lending markets is to avoid being penalized by your government. It's not the only need, but it is one of them. If I couldn't pay that $190, you know, it was due on Tuesday and I got paid on Friday, you know, for my business license, I would pay if I had to NCUA's payday alternative loan at 28% to avoid the charge my government is charging me. And so I will commend NCUA before I got there for starting their payday alternative loan. They call it POW. And we're fighting fire with fire, a better option. I'll tell you this, that when we were interviewing at NCUA for a general counsel, I asked all of the applicants a question. I said, the taxis, when I lived in New York City, routinely violated the city rules, right? They wouldn't take you to certain neighborhoods. They wouldn't take you at certain times of the day because they're finishing their shift. They wouldn't take you to Staten Island, even though there's a whole bureaucracy set up to stop that, okay? And, you know, there was the notion that they wouldn't pick up certain people who looked a certain way. And I asked all the applicants, what solved that problem? I can't go to my neighborhood. I can't get a cab from my neighborhood. They don't pick me up because I look like whatever. And if they didn't answer, the rideshare economy, Uber and Lyft, I didn't want to consider them for the job. The market solved that problem. I'm not here to promote either one of those companies. And lastly, I'll say one thing that NCUA has done and will continue to do is promoting financial literacy. Credit unions are good about this. And a lot of financial problems go away, late fees, being jammed up when you're unemployed, if you manage to give yourself some financial security. This book right here, Everyday Millionaires, I recommend it to people. I bought it on the open market. I don't know the author, but it's replete with, you know, a teacher and a cop who become millionaires later in life by doing the obvious, just putting away money in their 401k, savings, et cetera. So a lot of these issues can go away. We're also looking at faster payments at NCUA, trying to implement blockchain technology, because the easiest way to avoid a high overdraft fee is to not have to pay it at all. We can avoid that argument. Even when I was in the Senate, I was paid at a 7-day lag. I was paid on 15-day lag. We were paid at a lag, the work we did. So sometimes the money that people get dinged for overdraft is money they've earned already. It just hasn't hit their account yet. So that's another example where markets are helping us provide more choices. I just threw a lot at you guys, but that concludes my opening remarks.
Well, before we get start feeding in questions from our audience, and I'll note for a reminder, I was remiss at the beginning. I did see on our registration at least one or two members of the media. If you have a question and you're a working reporter, please indicate your name and your publication in the question, and that will help me let our guests know where your question's coming from and likely prioritize it toward the top. It's an open forum. We have all sorts of folks involved, including people from Capitol Hill that are interested in this topic. But let me turn to John Berlau here. John, by batting cleanup, you're going to help me make sure that we focus on barriers created by financial regulation. And if you would, I'd like you to also pick up on a thread there that Kyle had about the solutions being new alternatives, and something that you've written about and I think is applicable here, why private organizations, banks, credit unions, other ways of organizing is a better and different way to go than public sector solutions that are sometimes put on the table. So John, the floor is yours, and a reminder to the audience, use the Q&A function if you want to participate in the conversation, or send me an email at events@cei.org.
Well, thanks, Kent, and thanks for the kind introduction earlier. And it's just so awesome to be on this panel with our distinguished guests, Professor Zywicki, who I've certainly learned a lot from. I appreciate the compliment that he's learned something from me, but who coordinated this effort at the CFPB to gather the empirical research for the great recommendations of the panel to improve consumer welfare and consumer choice, to improve consumer welfare mostly by improving consumer choice, and Vice Chairman Hauptman, who is a dedicated public servant, who is working to implement these and other great ideas to improve the lives of consumers, to credit unions, and to bring credit unions to more consumers. Now, to say the least, adherents of the free market like myself and my colleagues at CEI are living in interesting, challenging times. Market-oriented ideas may not always be well received among those who now hold the levers of power. With Vice Chairman Hauptman's agency, interestingly, it's a little different because Republican appointees do still hold the majority for the next couple of years. But even there, I imagine it can be hard to conflict with, if they need to conflict with other financial regulatory agencies that may have a different perspective under the current administration. But we at CEI are hopeful that many of the recommendations of the task force, which are similar to policy proposals CEI has made over the years, can transcend partisanship, because we view them as compassionate, forward-looking, and in the sense of welcoming and encouraging progress, progressive in the best sense of the word. And many of the ideas have indeed attracted bipartisan support. Both CEI and the task force, for instance, are sharply critical of Dodd-Frank's Durbin Amendment, which slaps below-cost price controls on the interchange fees banks and credit unions can charge retailers to process debit card transactions. Professor Zywicki's research at George Mason University, even before he was on the task force, shows how this policy is regressive, transferring the cost of processing debit card transactions from some of the nation's largest retailers, such as Walmart and Home Depot, to the back of the poorest consumers. Professor Zywicki's research shows how the Durbin Amendment raised fees and sharply reduced free checking for low-income consumers, and has resulted in more than 1 million consumers being unbanked. And the good news is that proposals for relief and repeal of the Durbin Amendment have gotten some bipartisan support, including, ironically, from Dodd-Frank's chief proponent and architect, Barney Frank, who never wanted it there, although he's responsible for a lot of the other bad stuff in the bill. And related, to Professor Zywicki's discussion of the history of consumer credit, the task force report also notes how the measurement of annual percentage rates mandated by the Truth in Lending Act in the 60s may not be appropriate for small dollar short-term loans and fintech offerings, and may result in fewer options for credit for the poor. And the report rightly also casts a skeptical eye on proposals for postal banking, showing how this might be a step backwards for middle and lower income consumers in the age of FedEx, Uber Eats, and the app. The task force finally, makes a compelling case, as Vice Chair Hauptman did, for new banks and credit unions, both fintech banks and industrial lending companies affiliated with retailers and manufacturers. It shows that opposition to approving these new financial institutions, these new banks, are more based on protectionism for established banks protecting themselves from competition, than safety and soundness in the financial system. And again, the idea for de novo industrial lending companies, new types of fintech banks and credit unions in the banking system should be bipartisan. And as banks, I have pointed out, banks affiliated with non-financial companies such as the Tesco supermarket bank in Great Britain, and Volkswagen banks, affiliated with a car company all over Europe. They exist in just about every country but ours, but we have stalled, some of the best run companies, from Walmart to now retailer Rakuten, from having banks in this country and providing some much needed competition to in the banking system. And finally, this report adds helpful suggestions on the bipartisan issue of criminal justice reform, and making sure that the formerly incarcerated who have served their time and paid the price, have access to financial services, and there aren't barriers there. And at the NCUA, former chairman and board member Rodney Hood has been working to make it easier for credit unions to use their own individual judgment to hire, if they find it appropriate, some of the formerly incarcerated. And now Vice Chair Hauptman, as he mentioned, is working on that issues and other things, as far as even allowing the formerly incarcerated to start some of their own credit unions, and making sure there's more access to the banking system for everyone. So again, I thank my distinguished fellow panelists, and share in the hope that these recommendations will be acted upon soon.
There's something really important there that I'd like to pick up on as maybe our first topic of discussion. And John was emphasizing it there at the end, and maybe Todd and Kyle, if I could ask you to discuss, I'd really like to help the audience understand this notion of access and inclusion. The stereotype, the shorthand that we see oftentimes in the headlines, is that the banking and finance is all about, the New York banks or Washington, New York corridor. But really what we're talking about are the dynamics of policymaking include very strong constituencies in the United States Senate for rural communities. We're talking about people that don't have access, immigrant communities, urban communities, former prisoners who have been cut out of the system for one reason or another. Could you, maybe Todd, then Kyle, both expand on this and what it means for forward-looking, not just the regulatory system we have, but what is a positive vision for financial services in America as we look at the 2020s and beyond?
Yeah, thanks, Kent. And I will say I would say this is the issue that animated us more than any other on the task force. And we would always argue over who got to talk about financial inclusion whenever we would do something, because it was, in my view, financial inclusion is not just good policy, it's a moral imperative. And I think that regulations and legislation and government action that reduces access to the financial products that people need to give them the energy, to give them the wherewithal to make their lives better, are morally repugnant. And I think it's outrageous. And I think it's just not right. And we have too many of those. And as you suggested, a lot of them are a byproduct of entrenched special interests who gain off of this system, preserving the status quo, but which the most vulnerable among us suffer the most. You mentioned a couple. We talk about immigrants, for example, and trying to come up with a better system of portability for immigrants. We talk about research being needed. Another thing that keeps coming up and that people haven't looked at is AML laws, money transfers, things like that for immigrants, and the degree to which anti-money laundering laws are about the most expensive part of the regulatory burden in dealing with consumers for a lot of companies. We need to do something better about figuring out the cost and benefits, because there are benefits, obviously, but the costs are very high.
Let me pause you for just a moment, because there's an element of that I want to bring Kyle in on, if we can. These areas where there's the regulation itself is the most costly part of the service for the communities that need it. We're also talking about, are we not, it seems to me, also talking about people that have the most difficulty being involved in the political process. I mean, it seems to me it goes straight to your core point about political accountability and democratic accountability. If people are not engaged in the political process, how do they say, hey, I have a problem over here because the regulatory costs are what are keeping me out of the opportunities to build wealth?
Yeah, I completely agree. Money laundering rules in particular, for example, let's say you had a financial institution in El Paso, San Diego, Tucson, those areas that are kind of one big metro area, meaning, El Paso, Juarez, it's all one metro area. They listen to each other's radio stations, same with San Diego, Tijuana. And you're making it difficult to offer services there because those kind of financial institutions, yes, they have tons of deposits in pesos, and they have tons of businesses that do business, abroad, across the border, and they send money constantly, right? And that's a completely normal thing to do in that part of the world, but we make it difficult for them. I'll say this, that immigrant groups used to be one of the largest sources of credit unions. Occupational was always the largest. Remember, a credit union, you have to have a common bond of some kind, okay? Often, the workers at Boeing, for example, the Disney employees have a credit union, right? But common bond was often immigrant communities. They would offer services in the language people wanted, et cetera. The first credit unions were Quebecois, who in New Hampshire, Canada had credit unions, and these folks went, 100 miles over the border into New Hampshire, and they were factory workers. And they said, let's set up what we had before, a French-speaking, credit union offering services in French. And that has really faded off. Meanwhile, this country has about, as high a portion of immigrants as we did at the turn of the 20th century. So that's something that we would definitely like to do. But let me just say this. When we talk about fintech and allowing new things to take root, okay? My goal is if credit unions can't offer these things, credit unions are going to be hurt if they're useful, okay? That's why we're looking at blockchain technology, trying to emulate what the OCC did, using cryptocurrencies, meaning stable coins for payments. Now, if you don't think these things matter, then don't worry about it. But if they are useful, that consumers are going to do them eventually someplace. And it's my goal to make sure credit unions can do these things so they can survive and offer these services so they don't have to go elsewhere. I look at, it's not just about inclusion, it's also about jobs and economic growth in this country. Every country lost their video rental jobs. Remember, we were kids, renting, and someone had to stock the shelves. Canada lost those jobs. We lost those jobs at Blockbuster Video. Everybody did. We got the downside of that disruption, but this country got the upside to go with that, okay? We have the headquarters for Hulu and Netflix and Disney Plus, et cetera. We got the early investment opportunities. So the worst thing that can happen to a country or an area or a industry like credit unions is to get all the downside of disruption and not capture some of the upside. Netflix is headquartered in the United States, not Canada. We both lost our video rental jobs, that kind of thing. So I look at it that way. And I think if we can advertise in different languages, if need be, hey, start a credit union, here's the process. And somebody at NCUA is responsible for getting viable credit unions up and running. They have to be viable, but the same way somebody at Burger King is responsible for getting new franchisees that are viable. In neither case, credit union or a fast food place, do you want them to fail? But the difference is at a Burger King, there's somebody who's responsible for tracking that process and creating viable. At NCUA, it's not quite like that. I don't blame individuals in the least. One issue of financial regulation is nobody gives you an attaboy if GDP growth is 0.1% higher next quarter because of what we did. But there will be hell to pay if the institution that Kent examines crashes and fails, right? You know, where were you? So humans will always respond to the incentives in front of them, and that's something we want to change.
I could just amplify very quickly, Kent, about a point that Kyle made and John made. The reality is the financial system nowadays works really very well for middle class and upper middle class people. We have an abundance of choice, competition. If I get dinged on my credit card bill because it happens to be paid late, I call them up, I threaten to cancel, they waive the fee, right? Same with the bank, right? It works really well. But there's a lot of people who aren't sharing in that abundance. And I'll give you an example of how this works. The Durbin Amendment that John mentioned. Most of us never felt the pinch of the Durbin Amendment. Why? Because the main thing banks did was they just dramatically increased the minimum monthly deposit that you have to balance you have to hold in order to get free checking. I didn't notice it. You probably didn't notice it, but lower income people noticed it. And then what happened to them was free checking went from 78% of bank accounts to 39%, 76 to 38% of bank accounts, and the fee you paid doubled. Think about the Credit Card Act. Here's a great example, which is middle class people love provisions of the Credit Card Act that says you can't market credit cards to college students unless you have an independent source of income or you have a cosigner. Who is more likely to have a cosigner on their credit card bill? An upper middle class kid at Swarthmore, or a low income kid from a single mother in UTL at the Texas A&M El Paso or whatever, right? The reality is, what we know is basically what that does is widens the access to credit. College students from upper middle class families get credit cards because they can get cosigners. Lower income families don't. What happens then is upper middle class kids get steps up on the ladder of financial inclusion. Lower income kids graduate from college and they are not they're financially invisible. They're credit invisible. And when you're credit invisible when you're young, you're more likely to be credit invisible when you're old. And that provision has delayed people getting credit cards, getting car loans, getting mortgages, primarily among low income people from those sorts of backgrounds. And it's time that we start taking these things seriously. That's a good example of something that was passed in a fit of moral outrage by a bunch of upper middle class, congressmen and their staffers, without thinking through what the effects are on real people.
Don't forget the points and the cash back. People like me, I use my credit card for everything. I almost never use a debit card, right? I pay off my credit card every month and I pay an annual fee for credit cards and I get all these points. I've gone on vacation, right? With, my Chase Sapphire and all this. Debit card usage skews middle lower income. Credit cards like I use skew higher income. And the cash back and the points, there were people who use their debit card all the time and Christmas presents were with their cash back from their debit card, or their one family vacation was that. And obviously when Durbin Amendment reduced the, it's not as big a deal with credit unions because they tend to be smaller, but that's just yet another perk. The cashing in your Chase points to go to, Tulum was not affected. Getting your perks from your debit card sure was.
There were actually, these have been excellent points. There were actually debit card rewards before the Durbin Amendment, and those have completely disappeared. And now retailers are pushing to add it to credit cards, where it's going to the extent that middle class people do get rewards from credit cards, that might disappear or highly, shrink as well if this is applied to this type of price controls are applied to credit cards.
Yeah, that was my point. Debit cards used to give the same cash back and points and all that that credit cards did, but it's not true anymore.
John, let me ask you, I want to see if I can tie a couple things together here, and you're probably the best person to help me start. Kyle just mentioned the markets are segmented, right? Different products, different services, different institutions reach different people and different categories of people based on their preferences or their income and wealth. tell us a little bit about some of the recommendations in the report from the task force speak to alternative use of different data sets to help assess creditworthiness, because I think that is part of the puzzle here of what we're hearing from Kyle and his colleagues at NCUA about how we can move these financial services into the future. So what has changed with how credit scores or credit worthiness is measured or should be changed?
I think we are going to be seeing just lots of things with artificial intelligence and about who can pay or who is most likely. We've been against at CEI. There have been some data saying, for instance, that we know insurance companies use, that people who have good credit scores, which doesn't necessarily mean somebody's rich. It means somebody, can pay, just makes an effort to pay their bills on time. That can predict who is a more disciplined driver and can get lower insurance rates. And one thing I think, of course, though, we shouldn't underestimate the intelligence of any set of consumers, and that one of the reasons that consumers survey data has shown this will take, say, payday loans, which are so vilified, is a lot of times this doesn't affect your credit score. So if you're going to be late for a utility bill, that could ding you on a credit score, or you can take a payday loan to pay that off. You may be in the short term. This is not financial advice. I'm not making any recommendations. I'll use the same kind of disclosure that Vice Chair Hauptman did. A consumer might think he or she is better off by doing that and maintaining a credit score, particularly if they wanted to start a small business. And I am the Kaufman Foundation in Kansas City about how there's less of a distinction than we think than between personal and business credit, that so many entrepreneurs will start with their personal credit cards, and that's like over 50%, and that's with both data and anecdotes of stories about the founders of Google, Brennan Page and Spike Lee and Quentin Tarantino for their movies, have just maxed out their personal credit cards to start their business. So before we think, a consumer behavior or allowing consumers to do this or allowing businesses to allow consumers to do this is bad and we ban it, we should, I would say as a libertarian, you just allow it in generally if they aren't hurting anybody else, but just look at what the data says about what they might actually be using their credit card, or what they might actually be spending on before you take away this option.
Now, Todd, is this one of those fields or pieces of the policy puzzle here where regulation stands in the way of, as you said, we had so much innovation in the last year, and it was kind of 10 years all crammed into one. Our alternative data sets and methods, the artificial intelligence that John's talking about, are we starting to see that, or do we have regulatory barriers still?
It's both. There are regulatory barriers, but this is one thing we became very aware of. The value of fintech. The value of fintech can hardly be overstated in this. Fintech solves a lot of problems or ameliorates a lot of problems. We know, for example, the empirical evidence now indicates that when fintech enters a market, the disparities between black and white borrowers, for example, shrinks. It brings competition to markets where there is limited competition. It promotes inclusion and it promotes, shopping. And as a result, it's competition, not monopolies, that eliminate disparities in pricing between different groups. And the value of alternative data became more apparent than ever this past year when the traditional underwriting models, we know the one that Fannie and Freddie approves and the like, is one that rests on, are you paying your bills? During this pandemic, nobody's had to pay their bills. Nobody's been paying their student loans. They haven't been paying their mortgage. They haven't been paying their credit cards. Nobody's collecting on it. Yet at the same time, we had a lot of people who needed access to financial products, who were good risks. And so what did we see? We saw alternative data step forward. The use of cash flow data, for example, is something we really embraced here beyond these old sort of play and plug underwriting markets. FICO, the credit reporting system we have, is one of the marvels of the modern world. It's imperfect, but everything's imperfect. There are ways it can be improved. But the current regime not only wants to bring in postal banking, they want to create a monopoly credit reporting system and a monopoly credit bureau, with the idea of attacking, promoting social justice and racial justice. Well, if you like the IRS, you're going to love the CFPB's credit bureau. If you think you don't like TransUnion and the like, try what it's going to be like dealing with them. So alternative data is really a big issue here. We think we agreed on the task force that it's probably one of the most important things that could be done to promote competition and innovation, together with some mechanism for fintech to prosper and to, in particular, preempt state laws in one way or another. We came down on the idea of allowing the CFPB to issue fintech charters for reasons we talk about in the report, whether it's the CFPB or the OCC. That would be a huge boon for consumers, number one, and number two, we need to make sure that whoever does it, that the incumbent financial institutions don't block it by things like unnecessary capital requirements and things like that.
I'm going to throw out my first curveball of the hour. A lot of this material that we've covered has been right down over the plate as far as the task force report. But I have a question here from Buddy in New York City. So the first one of you to jump on this gets to answer it. He asks, how about those of us who want to become unbanked but can't? Banks spy on you 24/7 behind your back on behalf of the government. What is being done to make it so that you can, for example, buy an airline ticket or rent a car for cash? So who wants that one? No volunteers, I'll assign it.
Although
okay, John.
I'm not sure I could directly answer his question. The Professor Zywicki and Vice Chair Hauptman mentioned the burden, both the economic burden and of the AML Bank Secrecy Act rules. In fact, when I was moderating at the Beacon Center in Tennessee, a panel on bank regulation, one gentleman who ran a community bank in Tennessee said the bank secrecy and anti-money laundering rules cost him more than all of Dodd-Frank combined, and he didn't like Dodd-Frank. I think it also, and CEI has joined with groups like the American Civil Liberties Union before, that this is very intrusive when you're basically deputizing banks to be spies. And so Ryan, my colleague Ryan Nabil and I recently wrote to the Financial Crimes Enforcement Network arguing against extending and expanding the Bank Secrecy Act regulations for a cryptocurrency money service businesses and exchanges, and that's on the CEI website. So it is very much an issue of concern that I think is, and hopefully is one that could unite, civil libertarians on the left and right. So I understand Buddy's concerns. I don't know if I have any specific advice on how, if he wants to become unbanked, but maybe these other gentlemen do.
Let's let that question sit. I'm going to ask you each, maybe for some closing remarks, 2 minutes or so, with the framework, if you will, of what can be done next. What can be done, and by next, I mean in the next 12 to 18 months. There are specific recommendations on the table now. There are opportunities to draw people together on Capitol Hill to do clear legislative reform. And there's ongoing activity at organizations like the NCUA to expand access and build new avenues for wealth building. Maybe we'll go in reverse order of how we started. So John, I'll ask you to kick us off here, and then we'll follow Kyle and Todd with a couple minutes each of closing remarks. What's next?
Ken. There are always specific things can be done, but I'm going to focus on one, which is there are applications pending at the Federal Deposit Insurance Corporation, and I'm sure they're pending at NCUA too for de novo banks, for ILCs at the FDIC. The E. Taylor Rockerton is applying to bring a banking unit to America, as I believe it has in Japan, that would serve consumers better, reduce transaction costs, credit card fees. And so those should be acted upon and approved despite the lobbying of the established banks, and approved. De novo banks should be approved in a timely fashion. So if they meet the criteria and follow the law, and they're otherwise under the standards we have deemed to be safe and sound. So act on, and let's approve those new banks and credit unions and bring competition into the system.
I'm going to add and extend. You do not have to subscribe to my remarks, John, but not only should we open up the market to new entrants, but we should guard jealously against incumbents raising regulatory barriers and going to their powerful senators and saying, let's keep people out or raise the costs on new entrants.
Absolutely.
Board member Hauptman, Kyle, what would you like to see next in your thoughts going forward?
Well, the one that is I have the most control over is our de novo process, right? It's a priority of mine, but again, there are people at NCUA who are looking at this before I got there. But from a management perspective, make an accountability for making sure these people get through the process as easily as possible. It's not NCUA's job to say how many credit unions there should be or how many a year. It is our responsibility not to be a speed bump unnecessarily. And if that returning citizens, the credit union for those incarcerated, if NCUA does anything to hinder that possibly viable credit union being open, we should never say a word about inclusion ever again. What I'll also say is when it comes to fintech in general, just things that are new have problems. We can point out problems and you'll be right. I will say that, for example, cryptocurrencies are used, I believe, less for illicit activity than physical cash is. Okay, as you guys know, more than half of the US $100 bills are not in the United States. Okay, we know what they're used for. So there are new things, fintech, cryptocurrency, they have problems, we can point them out. But guys, we had 0 plane crashes before we had planes. There were no computer viruses before computers. There's gonna be negatives, and I just wanna hope we have a classically American attitude of take what's new and win with it, rather than a fear there's something new. And as Kent said, some of that's a political process. I was on Capitol Hill, I saw incumbents come in, a lot of business groups, even Republicans, they're free market when they wanna be, and not when it doesn't suit them. So anyway, de novo, and don't fear the new. Profit from the new the way this country always has.
No, I'm tempted to let that be the last word. That was like a rousing charge. But Todd, I promised you that we'd give you a couple minutes to tell us what to look forward to and where we can move policy in the right direction. Why don't you take us out before I have a closing notes on our next program?
Sounds good. Thanks, Kent, and thanks, Vice Chairman Hauptman and John for being here as well. And thanks for hosting this forum, Kent. Our report was sort of inspired by a 1972 report on the National Commission of Consumer Finance, and that sort of served as a charter, intellectual charter for the next 50 years, several decades of how to think about consumer financial protection. They were talking about things like computers and that. They were also talking about the need to get rid of usury ceilings, which seem to be like weeds. They always come back no matter how harmful they are. One of their recommendations was that it would to create a new Bureau of Consumer Financial Protection, or a new agency for it. And that only took about 40 years. We knew we were writing our report during an election year, and a common question we get is, so what now? What now for this report? It was obviously under a Republican director, and we understood. And everybody among us, we had over 150 years of combined experience in this area, and so we knew we weren't writing for this year. We were writing for the next decade or 20 years as we were writing this. And so one of the questions people ask, well, what's possible in this political environment? I'll just give 3 quick closing thoughts to suggest categories of things where the current CFPB and Congress might be interested. The first is that there are simply things in here that everybody should like. So for example, I mentioned at the outset, so we should consider whether or not ECOA should be expanded to include disability, and whether or not it should still be the case that it regulates sex discrimination, such as loans for in vitro fertilization and the like. We should the single biggest set of recommendations we have is on research. Another thing we talk about is the need, as you mentioned, or Kyle mentioned, rural communities. We know very little about financial inclusion in rural communities, but the problem is getting worse. Well, it's a lot because of Dodd-Frank. Small rural banks are closing. And people in rural communities don't have access to online services the same way that we do. So there's a lot of things in there that I think everybody should like. The second thing is there's a category of just good government recommendations, modernization. One of the things we talk about, for example, is how the CFPB could better use its tools. It's got 5 tools that no other agency in the world that we could ever find has. Consumer Protection Agency has regulation, supervision, enforcement, financial literacy, and research. And we talk about how the CFPB could use its tools better, how they could move towards more of a system. The whole financial system could move more towards principles-based regulation versus prescriptive rules. And the third thing is, I think one of the services I hope we did was to at least talk about things where everybody cares about the ends, even if our friends don't agree on the means. And I gave the example of the Credit Card Act. It's manifestly clearly the case that the Durbin Amendment is increasing costs in unbanked among lower income consumers. It's clear that the Credit Card Act has caused a lot of higher risk and lower income borrowers to lose access to credit cards and thereby have to turn to less attractive products. And it's clear that competition, the whole history tells us that competition, innovation are the best ways to promote financial inclusion and to empower people to be able to find the products that they need. And I hope that within that framework, people will take seriously what the empirical evidence shows us about the effects of regulation, especially for those at the bottom of the ladder, and the benefits of giving them the same choices and abundance in a competitive market, which has become more possible now more than ever because of financial technology.
I want to thank each of you. This has been a wide-ranging conversation. There's a lot of meat on the table to really focus on throughout the year. And I want to thank also our audience who helped me with questions. They're the reason that we do this. A lot of those people are influential with policymakers, and your communication through this forum is helping them understand what's at issue and how to move forward. As a reminder to everyone, there'll be a short survey that pops up on your screen when we close the forum. We take very seriously the feedback that you give us, so I appreciate just a few questions, 90 seconds. And we have 2 programs lined up for later this month that I would encourage you to mark your calendars for. Next Thursday, the 20th, my colleagues Jessica Malugin and Ian Murray will have a conversation with Robert Bork Jr. about the landmark publication and the recent reissue of his father's classic book, The Antitrust Paradox, A Policy at War with Itself. Following that, on Wednesday the 26th, Ben Lieberman, CEI's Ben Lieberman, will host a conversation on the effects of restrictions, federal restrictions on energy leases in the Permian Basin. That conversation will take part with President of the Western Energy Alliance, Kathleen Sagama, as well as Garrett Golding, an economist with the Dallas Fed who's recently written on this issue. To take part in either of those programs, you need to register. Happy to have you. And there will always be available on our website, archived under the events tab, where you can find this event later this afternoon. Thanks again to Kyle Hauptman, Todd Zywicki, and John Burlow. That's the end of our program this afternoon.
Thank you, Ken.